Notes? No notes? Okay, can you hear me out the back? Can you hear me? Can you hear me out the back? No? Yes, thank you. Welcome back to week 11, the second last week of semester. And we're looking today at fundamental analysis. Last week we looked at fundamental. So what's fundamental analysis? That's when you're valuing the firm from the bottom up. And there are three factors that affect the value of a firm: the economy, the industry, and the firm-specific factors. So this week we're looking at more firm-specific factors. But the goal, as always, is to think about this. What you want to do is to buy a company at a price that is less than what it's worth to you. So this could be the market price or the price that a seller is willing to offer you. And so the analyst has to determine if the intrinsic value is equal to the market value. And the point we made last week is that a good company doesn't make a good investment. You can have a great company, extremely well-run company, and that value could be all reflected in the intrinsic value, or rather all reflected in the market price. If the market price overshoots, so everyone loves this company and they buy it, the price might be greater than the intrinsic value, even though it's a well-run company, it's not a good investment. But conversely, a bad company can make a good investment if its intrinsic value is less than its market price. So the question now is, at the fundamental level, we're asking this point: is security selection worthwhile? And there are two answers to this. The first answer is that if you're investing in a private company that's not listed, then you have to pick an individual company. You have to do an individual company analysis. You can't take the market price. This question is being posed in the context of a publicly listed security. That is one for which the price is given on the market, and you are able to compare your price against the price of the market. So the question here is, given that this price is available and that other people have worked on this before, is it worth your while? So there are three things I want you to get from this lecture. One is to get a sense to the answer to this question. The second thing is to give you the framework to evaluate it. And the third thing is to identify some issues that are really outside the scope of finance, so why you need to look outside of finance to be able to do a proper analysis of a company. But just to focus on this question here, is security selection worthwhile? And so Warren Buffett says, diversification is protection against ignorance. It makes little sense for those who know what they're doing. And his point is that rather than trying to pick your stocks, you might as well simply invest in an index portfolio or a broad portfolio if you really don't know any better. But for people like him, he says, who presumably know, then it's okay. Or really, is it okay even for people like him in his position at this point in time? That's something I'll be looking at here. But one point I'm announcing this question, I'm going to say it's his right. Diversification is protection against ignorance, but it's very, very hard. It's very, very difficult. And what I want to do in the next 20 minutes or so is to give you a sense of how difficult that is. When I talk about difficulty and complex, it's not really the kind of thing like you might think, putting together a rocket ship or famously doing brain surgery is difficult. But it's difficult in a way about the application of judgment. And I want to give you a sense of how difficult that is. I'll give you with the statistics, and then I'll give you some specific examples to show you what you're up against. But these are some views of some people. So this is Henry Blodgett, who's infamous for, at one point in his career, recommending stocks and then systematically selling them, so offering people to promote his stocks. And then on the side, there were such bad stocks that he called them dogs in his emails, and then he was, did some time in jail for that. But he's now reformed himself. He's a very good commentator. And so he says, for the vast majority of investors, including professionals, stock picking efforts waste both time and money. Similarly, Marcus Padley, who writes a very entertaining column in the Sydney Morning Herald, you get a sense of how entertaining he is by this passage from him. He says, forget Warren. You're not Warren. So this is for people who want to aspire to pick stocks and religiously go and try to follow Warren Buffett. He says, you are you. Rely on that. Or rely on the fact that as close you're going to come to Warren Buffett is living in the same crappy house and driving the same crappy car for the rest of your life. Because famously, Warren Buffett doesn't drive the fanciest car, nor does he live in a fancy house. He lives in an ordinary house. But it's good advice, by the way. You should drive, in terms of you should drive the cheapest car your ego can afford. That's good. But then you have other people thinking that, where you should be able to invest. One reason, we're talking about the big companies where they're picked over a lot. So maybe you should invest in the sides of the market where not many people are active, and that is generally the small cap universe. That is the small companies with small capitalizations. And they point out that in this case here, it's active management. You shouldn't take these fund managers argue, you shouldn't take a diversified approach, but you should buy and sell the shares, but leave this only to the professionals. Don't do this yourself at home. Okay, so this is something for the professionals to do. And they say small caps are a sector where experience counts. And this kind of thing here is, there's a sense that the market is efficient, because there are so many more investors coming to the market. They say the model of the market isn't perfect, but nobody thinks it is. And he says this was a rewarding activity 40 years ago, but the situation has changed a great deal since then. A little bit of a tangent here, but a lot of people you'll hear every now and again, some people say that the rise of exchange-traded funds or index funds is making the market more inefficient. Why? Because index fund is passive fund investing. And it's true that a lot of funds now are going into passive funds, given the record of, as I'll show you shortly, the poor record of active fund managers. People are now sending their money, driving it into index funds. So the supposed problem that this poses for market efficiencies, people are saying, well, if not enough people are analyzing the stocks, if, say, passive funds take up 40 to 60% of the market, then we aren't having enough people analyzing the market, so the market will become inefficient, dumb, because no one's actually doing anything. They're simply following passively the prices. That actually isn't true. And it's not true because there are more index funds. And in fact, you'll find that some index funds now are offering you zero costs. So this kind of looks a bit odd. How can a fund offer you zero cost to invest in a market on your behalf in an index fund? How does it make its profit? It turns out that the way the funds make their profit is by taking your money, buying the shares, and then using the shares to lend to the short sellers in the market. So the rise of index funds has made it more possible to short companies, because now you have a greater supply of stocks to be able to short sell, to borrow to short sell. And so that's what's making the market, that's one of the factors that are driving to make the market more efficient. And indeed, by all measures, and I won't go through the measures over here, but the market is in fact becoming more efficient in that sense. In fact, there are 4 other factors that the rise of index funding is helping to make the market more efficient rather than less efficient. It's kind of counterintuitive. I don't have time, but now that I think about it, I'll write down a short summary and post it up on the thing to explain the 5 factors that are how index fund is helping to make the market more efficient. But given that it's become more efficient, it becomes a bit harder for you to do an active fund. If you're doing anything less than investing in the index, then you're effectively saying that you can identify the over or undervalued securities. But we see here that, so this is January, recent paper. So the Vanguard's market cap valuated fund managed to beat about 85% of the large capitalisation Australian fund managers in 2018. This story is one I've been repeating ever since I've started lecturing, which is over 20 years. So it's the same thing that we find that managed funds tend to underperform the active fund. And finally, we see the funds are now flowing out of active funds more into passive funds. The question here that's been asked is, why are they failing to beat the index? So one argument was that because the fact that the overall interest rates were falling, when you have a falling interest rates, then the market as a whole rises. And for reasons that escape me, this was meant to make it more difficult for passive funds to outweigh the market. Because while they were undiversified, the market as a whole was rising much quicker due to the fall in interest rates, and so they found it difficult to beat. So the argument was that when the volatility returned in the market, when the market started exhibiting, so that's when the active fund managers would be able to use their superior skill to be able to avoid the volatility and deliver the performance. But it turned out this isn't the particular case. So I'm a member of the University Investment Group, and I look the committee that reviews the university's investments that are kept with a fund manager. And one of the fund managers is supposedly an absolute return fund. I think I might have told this story before, but the point is, this is exactly the explanation they gave. The definition of an absolute fund is one that gives you a positive return regardless of what the market does. And except that last year they gave a negative return. So I said, why? They said, the market was too volatile and we found it difficult to get in and out of stocks. But I said, that's what you're meant to be doing. That's exactly that period is when you're meant to be out delivering. So I can see here that they happen to be the ones I was questioning, but their performance was fairly typical of most. And they'll often say, in the longer term, and this is again what they said, look, in the short run, we've had some unfortunate underperformance, but in the longer term, we'll do better. I'm not holding my breath, because the figures show that in the longer term, more of these funds tend to underperform. So over 3 years, 67% of funds lagged the market. Over 5 years, it was 63%, and over 10 years, 10%. So in fact, the longer the period, the more lags there are in the market. So the question, into all this, then there comes a paper, which I thought is really insightful, and I'm a bit surprised it hasn't received the attention it has amongst financial economists. But Henrik Bessenbinder, the academic there, posed these questions: do stocks outperform treasury bills? On the face of it, this seems kind of an odd question. So if asked most people, do stocks outperform treasury bills, the answer would be an emphatic yes. The answer seems to be, it's the kind of a question that you might expect a first-year finance student to ask, or someone, a layperson. But it's not a question you expect a finance professor to ask, because this is the evidence. In fact, stocks outperform treasury bonds to such an extent that there is something called an equity premium puzzle. The extent to which they outperform on average is so great that it's hard to explain by any rational risk avoidance strategy. To give you an indication of the outperformance, if you invested $1 in 1902 in each of stocks, bonds, treasury bills, gold, or the US dollar, by itself presumably, this is the return you would get. So this is after inflation, the US dollar would be worth 0.5% from the dollar back in 1802. Gold gold would be worth $4 up 200 years later. Bills would be worth, US Treasury bills would be worth 281. Bonds would be worth 1,778. And the stocks, assuming you reinvested your dividends, would be worth $704,997. A staggering degree of outperformance. And no one seriously questions these results. They seem to be. So it's odd that they ask, except there are some periods, such as this period over here from 1999 through to 2016, where the bonds, US Treasury bonds, outperformed stocks, due largely to the drop in 2008. And so over that period, what's been happening is that interest rates have been falling. When interest rates fall, the price of bonds have increased, so bonds have had an increase in returns. Now, do we expect this to continue in the future? No. You won't expect this outperformance because the price of bonds are so low, the return on bonds is so low, it's hard to imagine how they could actually be they could have a positive return. But in fact, why people are willing to hold so many bonds for so little return is now the puzzle. But, so, this is, the point he's making, though, is not that. He's making a separate point. He says, what's driving this? The majority of stocks severely underperform US Treasury bonds. So he says, the majority of stocks that have appeared in the CRSP, and the CRSP database is a database maintained at the University of Chicago that has kept track of stock prices since 1926. They say they have lifetime buy and hold returns of less than 1 month treasuries. What this means is that if you invested in 1 month treasuries, and that's the lowest, the safest, most liquid security, government security, so that's why it's got the lowest rate of return. But the majority of stocks, after including dividends, etc., over their entire life offer you a lower return. In fact, over 50% of them offer the loss is minus, 100%, so minus 100%. You lose all your money. The returns that we see, this exceptional performance that we see over here, is driven by just 4% of companies. The rest of the companies, 96% of the companies, either lose their value or just make enough, so on average, the other 96% make enough to just match the US Treasury bills. So the secret to an investor then is to identify the 4% of the companies that are outperforming and ignore the rest. So Warren Buffett is right. If you know what you're doing, if you can identify that 4%, then you're set. In fact, you make exceptional returns. You're avoiding the ones that are losing money, and you're just focusing on those 4%. And so he says the results help to explain why poorly diversified active strategies most often underperform the market averages. Because if, for whatever reason, you've missed out on that 4% then you're sure to underperform. Okay, the next thing I want to do is, how difficult is this to identify? You have a sense that this is difficult, right? But how difficult is this to identify this? Where are they hiding? You must be thinking they must be hiding in some, this might be some undervalued security that suddenly shoots up and becomes. Or what kind of a stock is this? What are the issues that we face in identifying these stocks that outperform the market? Well, that's not the case. It turns out that these stocks that drive the market, and in fact he says 4 stocks drove something like 10% of the return. But here you see, and this is an example of the kind of stock that helps drive the market. This is the FANG stocks are known as Facebook, Alphabet, Amazon, Netflix, and Google. And these are the companies that are driving the stock market. So, publicly large, publicly available companies. They're hardly unknowns, and these are the ones driving the market. We can see here from the kind, we have Netflix, 92%. This is back in for 1 year return. Amazon, 76%. Google, 44%. Facebook, 43%. Apple, 38%, etc. So I think, oh, this can't be too difficult. Except that the issue now you think is, are they already overvalued? Because if everyone's onto them now, maybe it's too late. Interestingly, Warren Buffett is invested in Apple. I'll come back to that. So, to look at the challenges, I just want to have a look at the performance of, the assessment of Aswath Damodaran. I've spoken about him before. If I haven't, or if you've missed it, I'm sorry. You should. Aswath Damodaran is, by many accounts, the world's #1 finance professor and valuation expert. So he's written about half a dozen best-selling valuation textbooks. He's hired by the investment banks. They'll fly him down to Brazil or something for the day. They'll pay him $100,000 to give 1 day worth of lectures. But the point I'm trying to make is he's highly regarded. He's got an excellent website which you should go to. Okay, so I've established his credentials. And he says Apple shares are trading at an attractive valuation. It's a cash machine. I've never seen a company generate as much cash as Apple has over the last 6 or 7 years. And then he goes on, he's got a blog, he says, Amazon. It's just 2 weeks ago that I started my post on the FANG stocks, starting with Facebook's, which I decided to buy. Did you get that? It's just over 2 weeks ago that I started my posts on the FANG stocks, starting with Facebook's, which I decided to buy. What's the date? 26th April 2018. Facebook had a return of 43% in the period leading up to February. The greatest finance analyst, arguably, decides, it's time to buy Facebook in April 2018. Doesn't that strike you as odd? That the stock, which is hardly lying under some kind of rock or anything, it's visible to you. You've heard of it. I've heard of it. I'm not on it, but I've heard of it. And he decides to buy it. What could have possibly have kept him from buying this? We must assume it's not that easy. Okay. So he's revisiting his Amazon. So this is Facebook. What about Amazon? Amazon had a 76% return over that period. So I valued Amazon for the first time in 1998. So he got in early, way before, and it crashed. It was about $100, then it went to $5, and then it subsequently went up. And one of the things that makes him worthwhile reading is that he just doesn't tell you about his successes. He tells you about his failures. That's what Damodaran. So he says, if you want to see some horrendously wrong forecasts, at least in hindsight, you should check out my valuation of Amazon in that edition. And he's very modest about it. When he does succeed, he also says there's a large part due to luck as well. So he says, I've valued Amazon about once a year, every year over its existence, and I've bought Amazon 4 times and sold it 4 times in that period. And he says there are 2 confessions. The first, that I've not owned Amazon since 2012. Okay? So he's missed out on Facebook, and he's missed out on Amazon. And second, through all of this time, I've consistently underestimated not only the innovative genius of this company, but also its and its investors' patience. So 2 things, and these are not finance issues, these are non-financial issues. So that's another point I'll be making, that to be a good investment analysis, you need to know more than just finance. So he's looking at Warren Buffett's Warren Buffett, the markets, he's looking at Amazon's market capitalization. This is the dot-com boom, and this is the bust. Its market cap soared from nothing to over 30 billion before collapsing to less than 10 billion, and now it's 100 billion in 2012, and it's greater than 700 billion early in 2018. And he's missed all of that out since 2012. He hasn't owned this since 2012. What about Buffett? So he's looking pretty ordinary as well. If you look at his index fund, for the last 10 years, Warren Buffett, this investor who attracts thousands of people to Omaha, to Nebraska, Omaha in Nebraska, has underperformed the index. So this is 2014, but his underperformance has continued since. So someone's saying over here, he compares Mr. Buffett to Michael Jordan, the basketball star. So apparently Michael Jordan was a star from the 80s. One of the benefits of being older is that I was able to watch him in the 80s. It was really good. You didn't know he was going to win. But then, as I said, there were two careers when he won, and then the second when he returned, and he wasn't a superstar. And that's he's saying what's happening to Warren Buffett. But the other thing about Warren Buffett is that having made his gains earlier, he doesn't need to do much more than simply keep up with the market. So as long as he doesn't fall behind too much of the market, and that's the other point over here, is that he'll be comfortably well off. And his company will continue because the market has been doing okay. He's not been lagging very much behind the market, he just hasn't been outperforming it. Why he doesn't beat the market anymore is quite simple. If you're a small company, it's easier to beat the market, and this tells you a return that would have doubled the company in its value in 1980 adds just 0.08%, less than 10% of 1%. So it becomes harder to find these big elephant investments that will double a company. So if you're 516 billion, where do you find a company or an investment that will, a series of investments that will double your return? Okay, so giving that, and I'll come back to the difficulties in valuing Facebook and Amazon again, but let's talk about some valuations here. And maybe I should have told you this before your assignment. It might have helped you, at least your anxiety. But if you're looking for some kind of true value in your assignment or some definitive answer, there isn't. What I can assure you is that we don't really care about your final answer. We're looking really at your analysis, your reasoning. So two people can come up with quite different conclusions, that lithium is a buy, lithium is a sell, and you could get equally high marks or equally low marks. But it's really the quality of your reasoning. What depends is the quality of your reasoning in your argument. That's what we'll be marking on. And you can relax. Most people do reasonably well. They're not in this. And this also makes sense because valuations are subjective. There is a buyer and there's a seller in every market. And what makes markets active, particularly when markets are active, is there's a divergence of opinion. If everyone knows what the true value is, there wouldn't be any trading in the market. The fact there's lots of active trading occurs when there are more differences of opinion in the market. So the more liquid the stock is, the more differences of opinion there are about the value of the stock. The other myth is related to the first one. There's no precise valuation. It's because we don't know some things, we can't know some things for certain. That's what makes it risky, but that's also what makes it either over or undervalued, depending on what happens. We had a good illustration of this, which I pointed out last week, I think. The Resource Capital Funds, James McClements and his company thinks there's no more value in lithium, which is why his company, although it specializes in resource funds, doesn't invest anything in lithium. But by the same token, Wesfarmers has made two major acquisitions, mainly because of their exposure, but they want some exposure to lithium. So they wouldn't be making that two acquisitions or trying to make two acquisitions if they didn't think there's any value in lithium. And the final thing is that the more complicated the model, the more complicated reality, the simpler the underlying model needs to be. The simpler the economic model, or the simpler the economic, the business model of the company, the more complicated you can build that model. So if you're building a toll road, which is a road, and then you charge people, that's a fairly simple business model. You can have a fairly complicated Excel spreadsheet. But something that's a bit more complicated, you're better off with a simpler model. So what are the approaches to valuation? This is three different kinds. People will often say that the gold standard is the discounted cash flow. It's the theoretically most correct way. You'll often find this. For that, you have the cash flows, and then you discount it by the cost of capital to give you the present value. You add up all the present values, and that's your. While people say that, you still have to come up with the cash flows and the discount rate. And so there's a lot of work involved there, and I'll talk a bit about that shortly. In practice, what happens most often, and I won't be spending much time in this, but what happens most often in practice is people use a relative valuation model. And finance is mostly about relative valuation. We don't have an absolute measure, but what we want to know is if there are two similar things, are they trading for the same price? So this is, finance is often called catch-up economics, and so catch-up valuation, where you're simply comparing two things, is that you see if a 1 litre bottle of ketchup is equal to $5, then a 75 litre bottle of ketchup should be worth $3.75. If it's worth more, then you don't buy, unless it's for convenience, in which case then you don't lug a big bottle of ketchup, you just want a little sachet, then you might buy it. You might pay a little bit extra for convenience. On the other hand, if it's worth less than $3.75 and you like your ketchup, then you might buy all 0.75 litres, buy 3 or 4 of them rather than 1 litre bottle, because you're getting a bargain. The same thing applies for companies. If you have a price earnings, you might have one company with a price to earnings, which is earnings per share of 20, or another company with a price to earnings of 15. Other things being equal, the company with the lower price earnings has a higher valuation, is a cheaper. Liquidation and accounting valuations are when the company is not a going concern or you don't have a market, and that's what you use, so we won't be spending much time on them. And real options I've spoken about before. So in valuing a company then, you've got two kinds of investors. The value investors, which are like Warren Buffett. So they focus on identifying with strong cash flows that are resistant to being competed against. So he likes to understand a company and then also understand the forces of change. He wants to make sure that whatever happens, they're not subject to disruption. They can be, they're unlikely to have effective competitors. Market timers, they focus on the changes in discount rates. And so looking at changes in cost of equity and changes in investors' appetite for risk. So if there's a decrease in an investor's appetite for risk, then it'll be reflected in a decrease in the interest rate. So what you need to look for here is depends on the change. The discount rate depends on the money supply and other uses of money. And so if you've been listening to the news, as I hope you have, the financial news, you'll notice last Tuesday there was a lot of excitement about whether or not the Reserve Bank would decrease, leave it unchanged, or increase its cost of the interest, the risk-free rate of interest. And as it happened, it kept it unchanged at 1.5. And I'll come back to that point in a moment. In relation to the top line, so the Numerator, what you want is the firm-specific factors, the quality of management, and the effectiveness of the strategy, and also the barriers to entry. As I said, value investors focus on those companies that are hard to compete against. So what Buffett says, you want to buy companies with a strong history of profitability and a dominant franchise, and his argument is that over time, a strong company is profiting from lack of change. A strong company will maintain its profitability. So it's the kind of business that's not going to be hurt by the internet. That's the kind of business I like. And he says, I like to buy stock in businesses that are so wonderful that an idiot can run them, because sooner or later an idiot will be running them, and so they'll be... Okay. This isn't particularly new to you. I just want to highlight some things here. So this should be fairly standard. Here you have the typical discounted cash flow model. This period is extended. So this is period 1, period 2, period 3, to period 4. How far should you go? You should go as far to the period where you can forecast, which actually typically isn't much more than 3 or 4 years away, although sometimes you'll go up to as much as 10 there. But which means that a lot of the times, most of the value comes in the terminal. You do a lot of analysis over here, but it's this last factor, the terminal value, where most of the company's value comes from. I'll explain that again. So, estimate the free cash flows, estimate the required rate of return, and sum the present value of the free cash flows. That's standard. Where do you do this? So here you have your own data or derived estimates from the annual report. So if someone asks you, how do you do this? You say, well, you go to the annual report, you work out the revenues, you work out the profit margin, or the cost of capital, and then your profit margin, and then you see how likely it is that will continue over the future. So you need to make some assumption about the growth rate. And you calculate the free cash flow on an after-tax basis. So that's the point I made earlier. The terminal cash flows, these are the cash flows that are expected to last beyond the period you can forecast, and we have the least information, but they can comprise a major value of the investment. Okay, let's get back to, I've given you this. Now let's try applying this to something like Amazon. I made the point that you need to have a simple model. And let's see how we can apply this model to Amazon. Why did Ashwath Damodaran get this wrong? Because remember, he just recently invested in this. Well, have a look at this company. Do you want to put that down? You. Let's have a look at this, the three figures over here. So you're looking at revenues, gross margins, and net profit. The total revenue of this company in 1990 was somewhere between close to zero, or this is millions of dollars. And then it has an exponential growth rate. You have gross margin, the operating margin, which is the difference between the revenues minus the cost of goods sold, and you can see here that has a big increase and then it declines. But then you have the other expenses of the company to subtract. And when you've taken away the other expense of the company, you can see the profit. You can see the profit. Where is the profit here? That's the profit. See? That's the amount of profit that you have. Now, what kind of imagination, what kind of forecasting do you need to be able to work out that this company is going to make such huge sales, make huge operating profit, and then just little operating income? You're thinking that this company is buying market share. It's not on a sustainable basis. And that's pretty much what Aswath Damodaran gets. So all your finance knowledge, which he's got a lot of, he's written 6 valuation textbooks, isn't really going to help you with this. You need to know what he's doing. So what the company is. You need to know something about the model, what the customers want, and why this is going to be attractive. And if you haven't come across this model before, it's very difficult to predict. So, as they pointed out over here, and this is one good thing, as I said about him, is very open about the way he analyzes things, including his mistakes. He said, Amazon has clearly delivered on revenue growth as its revenues have gone from 1.6 billion to 177 billion in 2017, but its margin went through an extended period of decline. So it says, in most companies, this would be viewed as a sign of a weak business model. So if you're extrapolating from your previous experience, this would be seen as a weak business model. But in the case of Amazon, it's a feature of how they do business, not a bug. Why? Because basically it's used its option. So it's now decided it's got a platform from which it can capture other markets, and so it's extending its products, Kindle Fire Prime, at below cost, so thereby driving its competitors out of business and thereby getting future market share. Okay. So that by itself is, as I said, it's not unique to Amazon, but what makes it different is that it's been able to get the market to go along with this. So over all this time, it's been able to convince the market that this model will work in the future. And even so, even present now, it's valued at close to $1 trillion. It's still able to, but its profitability isn't as high, anywhere near as high, but it's able to convince the market that it can go along, that it will eventually make money. There's another element to this as well. It's also able to sustain this middle business model because of the decrease in interest rates. If interest rates weren't as low as they are now, people would be discounting its future cash flows much, much higher, and so they wouldn't be able to, people would say, well, you're making the profits too far in the future, we need them much earlier. And I'll show you that in a second. The next step then is the discounted cash flow is to look at the DCF valuation. So if you go into a company and they'll ask you for your interview, how will you calculate the discount rate? The answer that you're looking for is use the capital asset pricing model. That's what everyone uses, right? So you'll say work out the capital asset pricing model. Then they'll say, well, is this appropriate? What kind of a risk premium would you use? So what is the risk premium? So they'll say, okay, that sounds good, but let me test a bit more. What's your risk premium? And the risk premium is the difference between the risk-free rate and what you're expecting the price of risk to be a risk. The thing to say is that, well, there are differences in views, but by and large, a 6% risk premium is what's commonly used. You can argue whether it should be a bit more or it should be a bit less, but 6%. And then you multiply that by beta, around about 1, 1.2, and you'll get a cost of capital of about 7 or 8%. In practice, what tends to happen is that people will use all of this, but they'll end up with some nice round number like 8 or 10 or 15%. For if it's a very risky company, they might use 15%. Or typically for a gold mining company, or they might use 12%. The point of this graph then is to show you the difference that's made by, I think you know this at some level, but it's helpful to see the numbers just to bring home the stark difference it makes of a change in interest rates. So it wasn't that long ago that we had interest rates of up to 15%, and see that $100 worth given now in the hand is worth $100 at all interest rates. But in 20 years' time, so if you're promising to deliver your returns in 20 years' time, the present value of $100 delivered in 20 years' time is 6.1%. In contrast, the present value of $100 delivered in 20 years at a 2% interest rate is 67.2%. 7.3%. So this is my point about Amazon. People, although they're not making profits now, people expect them to be making profits sometime in the future, and even though the future might be far away, they're not discounting it as much because interest rates here are so low. So they're not losing as much from the fact that they haven't made any profits yet, but they'll be making them at some point in the future. You can also, that fuss about the change in the Reserve Bank of Australia, whether or not it would reduce or change the interest rate. You can see here that if they'd gone from 2% to 1%, this is a perpetuity, the value would increase, would double. So the change in interest rates makes a much, at the lower level, when we have very low interest rates, a small change in interest rates make a much bigger difference in the value of the company. Not so much to the profitability. So you go from $100 to an increase in 110. You have an increase in the present value, but not by as much, not a proportion. Okay, we'll take a break there, come back at 5 to 4. Okay, sorry. So two things happen in the break. One in the break in the morning and one just now. So in the morning, just now I spoke to someone who attended my morning lecture and sometimes comes to my afternoon lectures, and he said, somewhat to my surprise, that I'm better in the morning. So I could have sworn that this is my better lecture by far because I have a dry run. But he said, I'm in a better mood and I give more tips in the morning. Anyway, you can't be the good judge of yourself, is one, which is why having student reviews is good. The other point that was made by a student in this morning's lecture is Olivia came down and she said that she'd been looking at Tesla and found that Tesla's profile seemed to fit the same one as Amazon in the sense that it's got lots of revenues, operating income, but very low operating margins. And she said that the problem that she's got over here is, while she can understand Amazon doing well and people, because Amazon is a monopoly, her problem with reconciling value to Tesla is that other companies like Toyota and Nissan were threatening to compete in the same space. So it's not obvious that Tesla would be the one that would win out in the end. So that's the point about valuation having a great deal of uncertainty. You aren't able to predict these kind of things. So the usefulness, so just the principles in, you sum all the present values. Once you get the present values, you get a total investment value. One point over here, you'll often get people talking about an enterprise value. What is an enterprise value? It's this. It's simply the sum of the equity plus the debt in the company. So I don't want you to get to an interview stage and someone says, work out the enterprise value of the company, and says, what's that? Well, what it is the value of the company, including equity plus the debt. But typically, you're interested in just valuing the equity. So if you're valuing the equity, you get all the present values, total investment values, subtract the value of debt, then you divide the equities portion of enterprise value by the number of shares to get the value per share. And then it'll be helpful to do a sensitivity analysis to see how the estimated value changes in response to changes in the discount rate, growth rate, and other variables, including capital investment. What you often find in professional valuations, they'll make the adjustments to reflect particular circumstances. So if you're looking at a minority shareholder, you don't have a controlling stake in the company, then you might add a further discount to the interest rate. So you increase the interest rate because the minority shareholders might get squeezed or get a worse deal than the controlling shareholders. Or you can add a premium for the growth opportunities if the company is in a better position to capture the growth opportunities than other companies. So Amazon has a premium for growth opportunities because its platform gives it the capacity to capture markets that other companies can't capture as readily. So although people think of the gold standard of the discount flow as the gold standard, it's really ultimately a function of the accuracy of estimates. And these estimates are a function of the economy, the industry, and also the economic environment, the firm-specific factors. So what I want you to do is to provide a structure for looking at your analysis. So we came across this last week. So you identified the sales volume, so that's the revenue, and then you look at the cost of sales, and the sales revenue minus the cost of sales will give you the gross revenue, and you can work out the profit per dollar of sales. And so the sales volumes times the profit margin is the free cash flow that's available to be distributed to the shareholders. And you discount that, and you might add a growth option, the value of the growth option, so that gives you the intrinsic value. So this is a bit out of date. We review real options later in the semester. We've already done that. So the discount cash flow will underestimate the company's value if you don't include real options. Okay, that's it. So the firm, you can analyze this a bit further then. you want to look at the sales volume and the profit margin. You look at the cost of the production, and then the product differentiation. What makes this product different, and what makes it attractive to the customers? And that's the point I want to talk about. I'll talk about some more. A large part of value or product differentiation nowadays comes from capturing the minds of the consumers. It's not about the intrinsic value, what we might think of the intrinsic qualities or attributable value of the product, but it's how much you can grab the customer's attention and interest in this particular product and loyalty. So that's something that is really outside the scope of finance. So I want to put this out there, that there's an element in valuation that is outside, that I don't teach in finance, and no finance course will teach. Maybe you'll learn it in marketing or other areas, but yeah, in fact, you should learn it in marketing. But it's about marketing rather than in the actual, it's captured in the actual product itself. I mean, the actual product itself does matter to a degree, but to less of a degree than you might think. And I'll give you some examples shortly. You'll then have a look at the industry attractiveness, barriers to entries, and the leverage capacity. What I mean by the leverage capacity is the capacity of the company to take on debt. Less of an issue now when debt is so freely available, but usually the more your company can borrow, then the greater its profitability, assuming that the cost of debt is less than the returns on assets. So look at the industry. You need to look at the industry attractiveness, which are the barriers to entry. And the thing is, some industries lend themselves to greater competition, others to less competition. One notorious or famous, depending on your perspective, industry which leads to low profitability is the airline industry. So this is Orwell and Wilbur Wright in Kitty Hawk, North Carolina. And this is the first heavier than air plane that ran for a longer period. It's remarkable that in less than 60 years later, we'd landed on the moon after this. The Americans, but mankind. So definitely a big positive to all of us. We've all benefited from air travel, etc. But on the other hand, you have this strange statement from Warren Buffett. Warren Buffett has said airlines are a bad business to get into. Indeed, if a far-sighted capitalist had been president of Kitty Hawk, he'd have done his successors a huge favor, by shooting Orville down. Because investors, shareholders, have lost more money in the airline industry than they've made. Most of the benefits in the airline industry has gone to the customers and to the people working in this particular industry, the pilots and others, the engineers, etc. Why is that? Well, that's part of if you have a look at that five forces framework, that gives you an understanding of why this is the case. But the point being, in doing this kind of a thing, you need to apply this kind of analysis to work out whether this company lends itself to providing profits to the shareholders, or whether those profits can be easily competed against. Part of the problem is that people get into this industry because they love it, and because they love it or they think it's a prestige symbol, they're actually not chasing returns, but they're chasing some other thing. So if you're competing against a country that subsidizes its airlines because it thinks it's prestigious, then you're not competing on the same terms. They're not looking at dollar profits, they're looking at some other intangible. This quote, it's a classic, but I find it funny. So the recession is when you have to tighten your belt, the depression is when you have no belt to tighten, and then when you lost your trousers, you're in the airline industry. Okay, so how detailed should the model be? So this is the point over here. The model shouldn't be, the more complicated the company, the simpler should be the model. And let's apply this to looking at Apple. Apple is famously is one company that Warren Buffett has famously stayed away from. because he said it's a tech stock and he finds it difficult. But recently he's decided to get into Apple, so he's bought into Apple. So I want to show you the judgment, the value, the kinds of judgments you need to do. And they said this is in 2012. Now it's the biggest ever US company. It hit the milestone, $622 billion, at a time when its influence on the economy, on the stock market, and on popular culture, and I'll come back to that, on popular culture, rivals that some of the most powerful companies in US history. It hit $1 trillion, it's come back a bit, but now it's $907 billion. So Apple remains the company whose approach to technology and design has become a standard for others. Now, this is back in 2012. What I like about these articles over here, and particularly this one, is that they tell you, they go through some of the processes, some of the judgments you need to make. So back then, we weren't sure whether Apple would hit $1 trillion, but they said, these are the things you need to consider and make a call. If they turn out all in the right way, then Apple would reach $1 trillion worth of capital. So that's why I've got that here. To show you how difficult it is, though, to make a judgment call, you have to be different from the pack. Apple shares hit a record $705, and so the analysts said buy. 50 or 57 analysts rated it buy, a strong buy. Only 2 rated it a sell. And this week, Apple shares continue to plunge and we're trading just over $450 down. So this is back in 2013. A couple of things. One is that analysts consistently rate shares a buy. That is no surprise. The worst they might do is they might say hold. If the company's fallen 50% in a week, then they might say sell, but which is too late. But most of the time, it's a buy, or if they're really, really feeling bad about the company, they'll say hold. Why is that? It's because they're actually not rated on their recommendations. They're rated on the other services they provide to their shareholders, such as speed of information, so not to their shareholders, to their clients. So the clients actually rate recommendations last. What they rate is information given to them by the analyst quickly. And for the analysts to get that information, they need to keep on good terms with the company. To keep on good terms with the company, to give them information, they need the company to pick up the phone. So you say, sell. And then you call up the company and say, can you tell me a bit more information about this? Who's going to pick up the phone and answer you? They might pick up the phone to swear at you and tell you what you don't know anything and put it down. So most companies find it safer to rate it a buy or at least a hold, but very rarely a sell. They're linked too much. So in some senses, this is not as bad as it appears because most people understand the analysts are there to say buy, not to. So don't take them literally, is my point. So the other thing here is that gross margins, and this is the point I want to make about people competing, that it's not just on the basis of your product, it's a basis of some other attributes. Gross margins on iPhone were between 49 and 58%. The iPhone alone accounted for nearly $9 billion of the $13 billion in profit margin Apple earned last quarter. Apple's iPhone sold for $480 each. So Aswath Damodaran had a race to the top being $1 trillion, the duel between Apple and Alphabet, which owns Google. So he rated them 126, this is a 2016. It was 162, and now it's 197. In between this, he bought and he sold them. So this is the model that we have over here. He's estimated the growth rate, revenue growth rate, 2.2%. And then in the last year, the terminal value, he says, is going to be 1.9% forever. The revenues, $243 billion, and then it's got a growth rate over 10 years, 289, and then in the steady state, 294 billion. Operating margin, 30% now, going down to 25% 10 years from now. And the discount, so the cost of capital, 9%, 8%, and then a steady state of 8%. Think about this 30% profit margin. How likely is it that Apple will keep this up? This is the profit margin by the US sector. Here you have air transport, it's less than 10%, banks, regional, over 20%, computer services, just over 5%, and computers and peripherals between 12 and 15%. Now, given what we know about competition in the market, what we're saying over here is that Apple is going to be able to maintain an operating margin of 25% way into the future. Is that possible? Is that likely? It's done it so far. So if we did it from the iPhone was invented back in 2007, it's still a phenomenally profitable company. Will it continue its profitability into the future? Have a look at this. So it's got its terminal value here, $40.345 billion in perpetuity. So that'll be the free cash flows predicting in perpetuity. Discounted at 8%, it gives you a terminal value of $661 billion. You discount that, that's from 10 years from now. You discount that back to the present, you get a terminal value of $272 billion. So in other words, that figure, that one figure here accounts for just about half of Apple's valuation. What we're saying, if we accept this analysis, is that Apple is going to be profitable indefinitely into the future. And if you believe that, then this is the valuation that you get. But you change that assumption a little bit, and your price will be a bit different. Yeah. So, as he points out, his price, he looks at a distribution of return. It's estimated value as a distribution, not a single number. And he argues that at the price of 94, at close of trading, Apple looks undervalued by 25%. And at least based on my distribution, there's a more than 90% chance that is undervalued there. And then 3 months earlier, though, he said his price was $134 a share. But what he did was change his revenue growth rate from 2.2% to instead of 3%, and then he changed the repricing of risk. So again, you can't, this could be justified, it may not, but you could come up with a similar number, and no one would be hard-pressed to argue against you. There's just a big array of ranges, of plausible ranges for Apple's valuation there. But even him, the uncertainty is such that he sold it in 2012. So the best mind of his generation in terms of investing managed to sell in 2012. So he missed out on that run. I mean, he's since bought it back later, then sold it again. But it's hard to get this right. And even when he says he makes money, to his credit, he says it's just due to luck. He doesn't attribute it to his own analysis. I think it's being a bit too modest. But okay, so these are the kind of judgments that you need to make. You need to create a service or product that's less than cost. You either lower the cost or increase the desirable product differentiation. You need to exploit the favorable industry and macroeconomic conditions. Or you can do this by improving the governance and better protection of shareholders. So if you can guarantee the governance, then that'll be a more attractive company and that'll increase the stock price. But to give you a sense of that things are always changing. So this is the point that Joseph Schumpeter made. He said, in a healthy economy, there's no industry that stays the same. You always have to be adjusting, which is why making the steady state forecast is so difficult. At the start of this 20th century, there were over 2,000 car manufacturing companies. By the middle of the company, they had winnowed it down to about 3 or 4, and one of the dominant ones was General Motors. 50 years later, the government took a 60% stake in General Motors. General Motors had been badly run for some time, but the financial crisis finally it's now restored back to private hands, but the point is, it was so bad that the government had to effectively nationalize it. To give you a sense of this, in China, and people say that they compete on the basis of low labor costs, etc., but even their labor costs are increasing in China. So China is facing the same dilemma, where they employed about 2,000 people in southern China, and now at the moment it's reduced its workforce to just 200 and leased most of its space to other companies. So there's a new model of manufacturing occurring. My point is simply although this is a little bit 4 years ago, so it's dated, but the point remains. There's a lot of turn in. So companies that keep on their profit margin, they do it not by any great manufacturing secrets, but by capturing the minds of the shareholders, of the customers. People talk about, maybe trade secrets are being sold and this is where they're getting an unfair advantage, etc. That's not where the real competition is. The competition is in for your head. And let me show this. So, a few years back, Samsung was the undisputed king of the smartphones, and Apple was a distant second. I always thought Apple was the number one, but apparently this wasn't the case until about 5 years ago. And Samsung's total shipments came to 85 million, more than the next 4 competitors. 1 year later, Apple edged out Samsung in global smart sales. Now you might think this is because Apple makes a better phone. So when I look up here, I see all these laptops that are open, and most of them, a majority of them at least, are Apple. Is Apple a better product? What is Apple's competitive advantage? Well, let's have a look at how much profit they're making. This is in 2014, but these profit figures are about the same. You're spending up to $1,249 for Apple's latest shiny iPhone, but it costs Apple less than that. So it makes $1,000 profit on each iPhone. Can you tell the difference between these phones? This is a Samsung one, clearly. And I'm not even sure that's an Apple one, no, so I think it's an Apple one. But anyway, it's hard to tell. So maybe if you can't tell by looking at it, maybe it's in the performance. So iPhone 6 plus the Samsung Galaxy, which one will be crowned king of the phablets? And the experts rated this. They said it's been a close run contest because each of these smartphones is excellent in its own way, but for our money, the better model of the two has to be the Samsung Galaxy Note 4. The Samsung Galaxy makes a real effort at making the most of its screen, which has to be said is a more impressive screen than Apple's. All hail the Samsung Galaxy Note 4, king of the phablets. But which phone do most people have? You don't have a Samsung. Most people don't have a Samsung. So what's the difference? It's not a better phone. It costs more. They've got your mind. That's what it is. So you're thinking about, this is all very maybe little bit mildly amusing, maybe. But this is a real thing. And I've talked about how Korea became the world's coolest brand. So as a result of decades of diligence, careful planning, investment, South Korea, with a population of 50 million, now impacts more lives per capita than any other nation. Its cultural reach is greater than any other. Let me give you one example. This is a Jesse Jackson t-shirt. Has anyone got one? Has anyone seen one? No? Okay. Apparently it's the coolest selling thing. It's in Korea and across Asia, this is a cool selling t-shirt. Who's Jesse Jackson? This is Jesse Jackson. Jesse Jackson ran for president in 1988. 1988. His t-shirt is now selling big in Korea, across Asia. Because it's cool. So Jackson makes a formal bid for presidency in 1988. What could possibly explain this? Maybe people are thinking, now we've got Trump. Let's go back to Obama. But never mind Obama. Let's go back to even further to Jesse Jackson, because he might have been really good. We can give someone else a go. That's not it. It turns out that the American ad campaign, its popularity has nothing to do with the US. This is an instance of Korean cultural power. So they explain this. With many Pan-Asian trends in fashion, beauty and music, South Korea sets the rhythm for the rest of the continent. Korean trends start mostly in the country's underground markets where everything is on sale for about $10 and the quality isn't so bad. Okay, so that's one. Then, once these images hit the internet, two things happen. Local garment makers check to see what's selling and then create their own slightly tweaked version. So then this first thing, you need to have the cultural power for people who worry about South Korea. People aren't worrying about what's happening in India or anywhere else. They're worrying about, in Asia, they're worrying about what happens in South Korea, because that's what's cool. That's the cultural power. Then the Chinese manufacturers scout the Korean websites and social media accounts for hit trends and make their own versions. And then when the Korean manufacturing items are sold outside of Korea, they're often sold as Korean trends. On Singapore's carousel, the seller offers the Jesse Jackson t-shirt as a representative garment of the Korean Ulsan look. Clearly, I don't know, but that's, you can look it up. And then it says the current cachet for crisp ersatz garments come not from Americans, but from the items association with trendy Korean women. With the popularity of Korean dramas, K-pop music, and Korean beauty brands, South Korea has taken the lead in soft power for the continent. So there you have it. It's cultural power in one instance. I was reading today's Financial Review just before the lecture, and this item came up. Someone said, don't dismiss the influencer economy. So people talk about this. This is nothing. It says it's easy for people to dismiss what they don't understand. So when I read an article in our sister City Morning Herald saying Instagrams are killing the vibe at Coachella, I realized the sheer complexity and power of the influence was largely lost on its author, as it is for many people over the age of 35, for which I'm guilty. So, but she made an interesting point, and I've put up this article on the things. She said, building a substantial media following on YouTube, Instagram, and then successfully monetizing the platform is not as achieved as vacuously or simply as many assert or assume. It requires creative effort, skill, and labor. It's a competitive market, and the aesthetics that sell are constantly on the move. I think it's a fair point. And I think the other point is also true. She says the gender double standard still prevails. We think of real tech investors, entrepreneurs, as being people like Apple, Steve Jobs, Zuckerberg, or Mike Cannon-Brookes. But to my mind, a tech entrepreneur is anyone that applies a business mindset to a new technology. So why not recognize women who have been adept at commercializing social media? So I think that's a particularly valid point. But my general point over here is, my broader point is that we're moving into a market, into an economy where competition is not based on the product itself, but on the right mix getting into people's minds. It's not that economic issues aren't fundamental, aren't important. There are. But the key question to ask is always, and you'll come across this, what is the value proposition? How are you adding value? How is this company selling something that is attractive? Okay, so to look at this, let's have one example which I'm hopeful will resonate in you, in that most of you will have done some travel, and then you might have used a travel agent, or you might have used the internet. There was a time not far back when people thought that travel agents would be beaten by, they would fail to exist because the internet would compete with them. They happen to be thriving. So why would you use a travel agent rather than internet? What are some reasons? One. Just one. Thank you.
They organize everything for you.
Okay. They organize everything for you. Good. Information overload. Well done. That's sheer coincidence. But it's an opportunity cost of time. There's a lot of stuff on the internet. How do you know it's reliable? Another?
They're more trustworthy instead of...
Sorry?
They're more trustworthy.
Good. Yeah, they're trustworthy. The lack of confidence and reliability of information on the web. Have you guys been looking at this? All right, okay. You're not looking at my slides in advance. You shouldn't tell personal anecdotes, but I'm just going to break my thing one more time. So this is a few years back. My family and I decided to go to Rome for a holiday, and we decided to book, use this newfangled thing called the internet and book on there. And so we booked online, and then there's a lot of sites. So we thought, how do you identify the right one? Yeah, they could be making it, because they want their money in advance. And then we simply went with a website that looked really well constructed, because we thought, okay, a well-constructed website, maybe more likely. So we arrived there in Rome early in the morning, and we take the taxi to this place, and then we land up, and the taxi driver deposits there in front of a warehouse. So my wife and I look at each other, and then we decided to be like adults and not start screaming at each other, because the kids were present. And but then it turns out that then a woman approached us and says, are you looking for the apartment? I said, yes. She says, it's over here. So it turned out to be a legitimate business, because she puts up a fake address to put, I'm not sure why, maybe to the tax person or whatever, but that's what she did. And so it turned out to be okay, but it really made me think that it's helpful to go through an agent sometimes. So there's the guarantee of the service purchased, and sometimes you get access to better deals. So if you get all of these qualities, then you think of the target market. For whom is this important? So you work out the size of the market. Well, this will be important to cash-rich, time-poor people. Okay? You might be the opposite. You might be time-rich, cash-poor, but there are lots of people who are cash-rich but time-poor. Or big companies. They want a standardized deal to manage their budget. They also don't want to spend someone's time doing it for them. So they just want to standardize deals. So that's why travel agents are important. They do. My point being, you need to know a little bit about the economics of this, but you need to know a lot about the specifics of the market. Let me take you to another thing. Why, again, you need to know the economics, but you need to supplement this with other industry-specific knowledge. What's the value delivered by Smiggles? Now, why is this relevant? most high street retailers, so most people who sell their products through a store, are facing trouble. So you go to Myer, David Jones, these companies are struggling, including Glue. He's saying that it's a fashion store and they're competing against international brands at prices 30 to 40% cheaper than brick and sales mortar. So have a look at this store. Now, again, this tells you something where you need to get into other people's imagination. Because I pass a store like this in the shopping centre, and I look at it and think, why would anyone ever go there? Now, what is the value of this product? I'm looking down here and I'm looking to see if there's a Smiggles things, but no, I can't. But the guy who does this is a genius, Solomon Lew. He's been around retail for a long time. He's in his late 70s, and he's a retail genius. The stationery brand is undoubtedly Australia's most successful international retail sailors, and UBS analysts forecast Smiggle will open 1,000 stores over the long term. It's a product mix that's not available elsewhere. Yeah, it's kind of understandable. But this has stopped it being cannibalized by Amazon and other online markets. And so, even though it's explained to me, I still don't understand it. I still don't understand its success. But it's undoubtedly successful. So that's that thing that you can't learn from finance. But you need to know the mind of, in a way, he does. And as I said, he's 70, so it's not like he's a child or whatever. But he knows what works and what doesn't. That's what makes him a genius. Yeah. Similarly with bookstores, this I can understand a little bit better. Physical bookstores would practically vanish by 2016. That was the prediction with the internet, because you can buy your books and the Kindle. But they're fighting back. Popular local books underpinned bookstores' resurgence. Now people are curating the experience in a bookstore, so they do more things than simply buy a book. You buy a whole experience there. The final thing I want to point out is that, as I said before, there are 3 dimensions to most jobs. You need to get the economics right, the technology, and the politics. And generally, the bigger you are, the more attention the links need to be paid between the economics, technology, and politics. So, contemporary example, the banks. So we talked about the banks. There's a cost. Just quickly go on to here. Mark Zuckerberg is now facing the price of success. He's now facing a political pushback. And in fact, the co-founder of Facebook, they invented Facebook when they were both students at Harvard, is Chris Hughes. That's Chris over here, says, it's time to break up Facebook. This is them back when they were in Harvard. And so he says, the reputation of Facebook is a dive. The company's mistakes, the sloppy privacy practice that have dropped tens of millions of user data in the political consulting firms, the slow response to Russian agents, violent rhetoric and fake news, and the unbounded drive to capture ever more of our attention dominate the headlines. And he says, Mark's influence is staggering. And this is something that actually I didn't think about before I read this. But he said, one man controls 3 communication platforms, Facebook, Instagram, and WhatsApp, that billions of users use every day. He controls around 60% of the voting shares. So really, if he wanted to, he could stop all of this. And my point is actually isn't whether they should or they shouldn't. My point is simply that now he's becoming so big, it's the politics that will matter for him. All right, I'll stop there. The password for this afternoon, this morning was Graham. So this afternoon it's Dodd, D-O-D-D. Graham and Dodd wrote the key textbook for analysis, fundamental analysis. So D-O-D-D. Okay, next week I'll turn off the microphone and I'll give you some tips. So I'll see you then.